Your safe inland home could be treated like coastal risk by your bank because of water restrictions, not a headline, a quiet policy shift, and it can hit before prices move. Here's the thing: lenders are tightening in places with extreme heat and scarce water, and insurance is following. Wired reports that when temperatures rise, approvals dip and values slide, driven by lender risk, not just buyer demand. Stay with me and I'll map the short list of red flags in your market and how to protect your buying power in 2026. Before we move on, please take a moment to subscribe to the channel and like the video. So why is your sunny inland cul-de-sac getting the same side-eye banks used to save for beach houses in hurricane season? Because the risk map quietly flipped. The drama moved inland, not crashing waves, crushing water bills, and brutal heat. Here's the thing: lenders are rewriting their models. Storm surge used to be the headline. Now it's water scarcity and extreme heat. The risk moved from waves to the water bill. If the tap looks shaky or the summer power bill looks like a car payment, the bank sees default risk, not curb appeal. And that's where the whiplash hits. Demand stays hot. You show up to an open house and it's a zoo. Multiple offers, escalations. Then your pre-approval gets weird. Your lender slides a new line across the desk, bigger down payment, or no deal. Same income, same credit, different climate math. It's like buying a used Tesla with a mystery battery. Paint looks clean, mileage is low. But the range? No one will say it out loud, and the dash won't tell you until you're stuck. Lenders feel the same when they underwrite a subdivision with watering limits and 110 degrees Fahrenheit summers. The math behind the pretty brochure says, this thing could run out of juice at the worst time. Wired points to research tying temperatures to lending behavior. Every 1 degree Celsius above average lines up with roughly 1% fewer mortgage approvals and more than a 6.5% drop in values. That's lenders tightening screens before buyers even blink. Not vibes, risk filters. Look at a fast-growing desert suburb under new watering rules. The comps look great. Year over year, still up. Meanwhile, underwriting turns into a pull-up bar. Shorter amortization to get risk off the books faster. Higher reserves because that AC bill might spike. Stricter debt to income because the monthly nut is no longer just principal, interest, taxes, and insurance. It's electricity in July and maybe water surcharges when the reservoir dips. Insurance makes it spicier. Carriers inch away or crank premiums. Deductibles creep. Some cap wildfire or hail coverage. Without affordable insurance, the collateral looks naked. Banks hate naked collateral. So they cap exposure, cut loan to value, or make you bring extra cash. You feel that as a rate bump or a condition you didn't budget for. And if you're thinking, okay, but my place isn't burning or flooding today, yeah, that's not the bar anymore. Lenders are running playbooks on cooling degree days, water rights status, and whether your utility rates jump during heat waves. The moment those metrics trend up, your file trips a silent review. Think TSA pre-check, but for denial. You glide until a buzzer goes off and suddenly your bag gets swabbed. So here's the mini payoff. Why is a desert home often harder to finance than a flood-prone coastal one? Because the coastal house can still buy insurance and sometimes build a levee. You can't insure an aquifer. You can't file a claim against a week of 112 degrees Fahrenheit and a strained grid. That's systemic, not seasonal. The home keeps costing more to keep livable, and lenders price that into your loan long before a for sale sign looks stale. Let that sink in. Your market can look strong on Saturday and still fail underwriting on Monday. And lenders won't send an angry press release. They tweak a checkbox. They move a buffer. Your approval slides. So if the bank's heat radar tags your zip code, what exact triggers trip the wire next? So what number flips your loan from you're good to uh-oh? It's not a single buzzer. It's a stack of boring metrics that suddenly act like a trapdoor. Think heat that won't quit, water rights that don't actually guarantee water, insurance that exists but only if you pay through the nose, and energy costs that shred your budget the minute the thermostat hits triple digits. Let's break it down. Extreme heat thresholds come first. When a zip shows more days well above its historical norms, files don't auto-deny, but they stop gliding. They get pulled for manual review. Lenders run internal overlays that watch cooling degree days because they predict summer utility spikes. Those spikes aren't just a comfort issue, they hit default math. Then water governance, senior or junior water rights, active restrictions, drought declarations. If your area leans on junior rights, a cutback means the house stays standing but the habitability math gets ugly. Lenders call that long-run maintenance risk. That risk shows up as lower max loan-to-value or beefed-up reserve requirements. Insurance stability is the third rail. Even if you qualify, carriers might cap coverage or push deductibles into "why am I paying this" territory. The bank doesn't shrug and move on. It recalculates your monthly carrying cost, folds the higher premium into your debt to income, and stress tests the payment at peak season. Suddenly, your affordable house eats the buffer you thought you had. Energy burden ties it all together. High cooling loads mean higher baseline costs. During underwriting, that isn't theoretical. It gets modeled. A city with rising cooling degree days gets tagged as higher default risk because last summer's utility bills already told on you. The lender looks at DTI realism, adds stress, and trims what you can borrow. Now the tension. Your realtor points to great comps, tight inventory, clean appraisals. Meanwhile, your lender circles three phrases: persistent 100 degrees Fahrenheit plus days, volatile premiums, uncertain water rights. Two realities, one house. One of them controls your approval. Here's the research signal lenders are acting on. Heat correlates with credit tightening. Each 1 degree Celsius above average lines up with around a 1% dip in approvals and more than a 6.5% value slide. They don't publish a memo. They bake it into the scorecard, and your file either threads the needle or it doesn't. Example time. A metro racks up hotter summers year after year. Cooling degree days keep climbing. The model predicts higher electric bills in July and August, so underwriting layers on a more conservative DTI and runs a harsher stress test. You pass on paper at 36%, fail at 40% under heat-adjusted costs. That's the approved to uh-oh moment you never see. Water risk does its own damage. With restrictions and junior rights, lenders see a future of surcharges, landscaping bans, and potential retrofit costs. The fix from their side is simple. Drop the max LTV or demand months of reserves. You feel that as a bigger down payment in cash you can't touch after closing. Insurance rounds it out. Say the carrier makes you harden the roof and clear defensible space. You do it. Still, coverage limits tighten and the deductible jumps. The bank reruns the payment with the new premium. Your cushion evaporates. The rate gets worse or the approval flips. Here's the tease. You can flip some of these flags. Efficiency ratings, resilience upgrades, and certain green mortgage products actually score points with lenders. Not vibes, documented performance. Mini payoff? There isn't one magic temperature. When days run hotter than history, files go manual. Empirical signal, roughly each plus 1 degree Celsius, approvals drop about 1%, and values fall more than 6.5%. That alone can nudge you into a pricier rate tier or a denial.